What's up, traders? So today I'm going to show you an option strategy that I use in order to retire in my 30s. Now, if you're new to the channel, my name is Rashad. I am a full-time options trader, and I bring in multiple six figures a year from the stock market, and I use the money I make from the stock market in order to pay for my entire lifestyle. Now, of course, first things first, make sure you go ahead and smash that like button so that we can get this video to over 1,000 likes. And in order to do that, I need your help. So please go ahead and gently tap that like button and go ahead and subscribe to the channel while you're at it. And do remember that I am not a financial advisor and this is not financial advice. All trading comes with risk. I'm just showing you how I've built wealth over time. Now, options have been a huge blessing to me throughout the last 5 years. Because besides it becoming my full-time income, it has allowed me the ability to do what I want, when I want, with who I want, for how long I want. So options have been a complete game changer for me. And up to recently, that was my definition of wealth. I thought the ability to do what I want, when I want, with who I want, for how long I want was my definition of wealth, until recently the Lord told me no, the definition of wealth is the ability to bless anyone at any time with anything. So bless anyone at any time with anything. And because of that word anything, I would say that I'm not wealthy yet, because I have it set in my mind that one day I'll be able to just go out and buy multiple houses and walk out to the street and give the keys to homeless families and walk away and not think twice about it. And so I have it set that I will do that. And when that happens, that's when I'll know that I'm wealthy, because I can bless anyone at any time with anything. I want to be like how Oprah did it. You get a car, you get a car, you get a car. No, you get a house, you get a house, you get a house. But options are how I'm building my wealth currently. And I believe that options will be how I'm able to do what I just described. And options really saved me in a sense. So for anybody who is not familiar with my story, I worked at a job making $10 an hour for several years, and I saved up very aggressively, so much so to the point that I was able to open up my first restaurant with the savings. And the restaurant did really well for several years, and then we were set to open up our second location. And so we started that process at the end of 2019, and we were set to open up that location in March of 2020. Now, the mention of that time frame by itself should ring a bell. You should all know what was happening during that time. And because of the pandemic, not only did we have to postpone our grand opening for the second location, well, we also had to close the other locations, and my income effectively went to zero. So not only was I not making any money, but I also just finished spending nearly $100,000 to get the other location open. And although we ended up being able to reopen a few months later, at the time that the pandemic initially occurred, no one knew when the end of it was going to be. All right, so here I am with a wife and 6 kids, and I'm making absolutely no money. And most of the money that I had, I have drained into opening up the second location. And so I was in a really difficult position, so I had to figure out a way to make money. And that is when I stumbled into options trading. I basically got into it out of necessity, but little did I know that it would absolutely change my life. And I am hoping that it does the exact same thing for you. So without further ado, let's go ahead and get into the strategy. Now, first things first, you can be a seller of options or you can be a buyer of options. And because I like to generate consistent and reliable income week in, week out, month in, month out, I like to use option selling strategies. Because if you're going to retire, you need guaranteed payments, because you need something that will replace your 9-to-5 income. And with option buying strategies, you have to hope that a stock goes in a specific direction in order to just make money. And if it doesn't do so in a specific amount of time, then it's possible for you to lose all of your money. Now, most people use option buying strategies, and most people use option buying strategies in the wrong way. So that is why you'll see the statistic that 95% of traders do not make money. And that's because most of them don't trade in a way that increases their probability of profit. So I like the guaranteed forms of income every week and every month. And option selling strategies will have you looking like these little fellas over here. And option buying strategies may have you looking like this little fella over here. All right, don't be this little fella. Cheer up, little guy, cheer up. But one of the option selling strategies that I like the most is called the short strangle. And the objective of the short strangle is to generate income and profit from the stock price staying within a specific price range. Now, a short strangle is just a mixture of selling puts and selling calls at the exact same time on the exact same stock for the exact same expiration date. Now, if we break down both sides, we know that selling puts is an agreement to buy shares, typically at a lower price, and selling calls is an agreement to sell shares, typically at a higher price. And you can think of option selling strategies as somewhat like insurance, but instead of buying insurance for like a car or a house, in this case, people buy it for stocks. So somebody can own ABC stock, and let's say they bought it at $100. Well, what they can do is they can buy a put, let's say at $90. And so when there is a buyer, there's always a seller. So we will be the sellers who sell them a put at $90. And we are agreeing to buy their shares if the stock were to crash below $90, and they will pay us for doing so. But what happens from here, as long as ABC stock stays above $90, we just keep the money we were paid and we go about our day. However, if ABC stock were to crash below $90, then we still keep the money we were paid. However, now we buy the shares at the $90 that we agreed upon. So it works very similar to your car insurance. Every single month you pay your car insurance premiums, and the car insurance company keeps the money whether you get into a car accident or you don't. And typically it's a very slim chance that you get into a car accident on any given month. However, if you do get into an accident, you want the car insurance company to pay for all the expenses. And so that is how selling puts works, but in this case, we are the car insurance company. So selling puts, we're agreeing to buy shares, and then selling calls, we're agreeing to sell shares. So here's a real example of selling a short strangle. So let's say that Apple stock is currently trading for $175. What we could do is we could sell a put at $165 and then also sell a call at $185. And for this, we'll use an expiration that is about 30 days out. And for doing so, we'll receive $400 in premium. Now, looking at the P&L chart over here, we can see that as long as the stock price stays within the range that we selected, we just keep that $400 in premium that we received and we go about our day. However, if it were to go too far on either side, so too far under $165 or too far above $185, then it would start to become a losing trade. But I will show you how to select the best strike prices that give you the highest probability of profit. And also, while doing this strategy on single stocks such as Apple could create a good amount of income, I prefer to do this strategy only on ETFs. And so let me show you the ETFs that I typically use the strategy on. All right, so when I'm teaching this strategy to my community, I typically separate the strategy for two different types of people. Now, the first is for people who have large accounts or who prefer not to buy the shares of the stock. And for those individuals, they could use ETFs such as SPY or QQQ. Now, SPY is essentially a basket of the top 500 largest companies by market cap in the entire United States. And then QQQ follows the NASDAQ 100, that is a basket of 100 different large cap companies that typically have a huge focus on technology. Now, the reason I use ETFs is for the decreased amount of volatility. Because when you're trading stocks like Tesla or Palantir, any of those stocks can move 20, maybe even 30% in a single day in either direction. And however, with ETFs such as SPY or QQQ, a 1 or 2% move in a single day is considered a huge move. And because of that, it's just much easier to make any adjustments that you need while doing this strategy on ETFs. All right, and now the second group will be for people who do not have large accounts or who are fine with buying the shares. And for that group, I use leveraged ETFs, UPRO or TQQQ. Now we can see UPRO follows the S&P 500 and TQQQ follows the NASDAQ 100. Now these are both 3x leverage ETFs. And so for TQQQ, if the NASDAQ 100 were to move up 1% for the day, then TQQQ would look to move up 3% for the day. And the same works in reverse. If the NASDAQ 100 were to move down 1% for the day, then TQQQ would look to move down 3% for the day. So it just looks to 3x whatever move the sector or stock that it's following makes. Now, what are the benefits of using leveraged ETFs? Well, because they are 3 times more volatile, typically you'll get about 3 times the premium. And also, it's much easier for people with smaller accounts to trade these ETFs because they trade at a fraction of the cost of the sectors that they follow. And just for an example, QQQ is currently trading for around $520, while TQQQ is currently trading for about $72. So you need much less buying power to trade TQQQ than you would for QQQ. But let's go ahead and head over to Thinkorswim and look at a potential trade. However, real quick, if you know anybody who could use help generating income off the cash that they already have, then tell them about the Trader Freedom community. The link is in the description below. But within the community, not only will they get my exact trades as soon as I enter them, they'll also get my full options framework via the Trader Freedom course. They'll get full access to ask me questions at any given time. And lastly, they'll be within a community of other traders who all have the exact same goal as them. So if you know anybody who could use help generating more income off the cash that they already have, tell them about Trader Freedom Community. The link is in the description below. But let's head on over to Thinkorswim. All right, so now we have Thinkorswim pulled up, and I'm in the options chain for QQQ. And the first thing we need to do is select our expiration date. And I typically go anywhere up to 45 days out. But let's say for this instance, we want to make sure to focus on monthly income. We want to generate that consistent and reliable monthly income since we are either retired or looking to retire off of options. So let's go somewhere around 30 days out. Let's do this date that is 27 days out. So now we've selected our expiration date. And the next thing I want to do is look at a few data points. Now, the first thing I want to look at is the expected move. Now, the expected move is just the largest move that the option market currently has priced in for that stock by that specific date. And if we come up right here, we can see there is a plus or minus sign, and we can see it says plus or minus $24. So that is telling me currently the expected move at its largest would be $24 to the upside or $24 to the downside. And so typically I want to select a strike that is somewhere near that move. And now the second data point that I want to look at is the delta. So the delta column we can see right here, but I look at the delta as the probability of the event occurring. And so at a 0.25 delta, that's telling me there's about a 25% chance that QQQ, which is currently at $525, drops down to this strike price, which is, let's see, $507 by this expiration date. So in other words, you would have about a 75% probability of profit. And for me, I personally like to stay at deltas of 0.20 or lower. And so if we come up here, let's see, if we look at this $500 strike, we can see it's a delta of 0.19. And so that would fit our criteria. And also at $500 with QQQ currently trading at $525, that would be right outside that $24 expected move that we looked at. And so that sounds good to me. So I will go ahead and sell our put at $500. So I'll go ahead and select the bid price. And now remember, on the put side, we are agreeing to buy shares of the stock if it were to drop down to our strike price by the expiration date. And so because of that, that's why I said that people with larger accounts could possibly use this stock, because at $500, then per contract, we are buying $50,000 worth of shares for QQQ. And if you don't have an account size like that, do not worry. I'm going to show you TQQQ here in just a moment. All right, but now we have our put side set, and now we need to come over to the call side and follow the exact same steps. So we'll scroll on down. So again, I'm over here and I'm looking for deltas of 0.20 or lower. And if we recall, our expected move was $24. And so the strike of $550 would fit both of those criteria pretty perfectly. So I'll go ahead and select the bid price here and it will add it to my ticket. And so we can see here, we are selling a put at $500 and we are selling a call at $550. And for doing so, we are receiving about $548 per contract. So you could come over here and you could change the contract amount to whatever fits your needs or your account size. But for the purposes of this video, we'll just keep it to one contract. But you could just multiply the amount of contracts by whatever fits your needs best. But if that looks good to us, we could go ahead and hit review and place the trade. However, let's go down and look at the P&L chart. All right, so this chart shows us our profit and loss. And we can see that as long as the stock price stays within the range that we selected, we just make our money and we go about our day. And we can see that the stock price is right here where these green dots are. And we can see if it goes down some, we still keep that $548 we received and we go about our day. If it goes up some, we keep that $548 that we were paid and we go about our day. However, if it moves too far to either direction, you can see we start to slowly make less money. And then it looks like our break even on the put side would be about $594. And then if the stock were to keep going down, then the contract would become less and less and less, and you would start to lose more and more money. However, let's now discuss how we exit the trade. Now, typically it goes in our favor, and I'll typically exit either side individually once they reach anywhere between 50 to 80% profit. And that's what happens most of the time. However, what if the trade goes against us? Well, first, let's talk about the put side. And so remember, I had this separated to two different categories of people. People who are okay with buying the shares and people who are not. Now, assuming you're okay with buying the shares, then I am absolutely fine if the stock price drops below my put strike, because I am absolutely 100% okay with buying the shares. So that is the put side. However, what if the stock price goes up and now it's threatening your call strike? Well, what I do is if it gets close to my call strike, then I go ahead and buy 100 shares of the stock in order to make that position covered. And from there, it essentially becomes something like a covered call. And as long as you have the shares, it doesn't matter if the stock price were to go well beyond your strike price, you're not losing any money. You're just agreeing to sell those shares that you already have at the strike price you select. Now, there's two ways to do this. You can just keep a mental note in your head to buy shares. Let's say if the stock price were to get to like $5.45, or if you don't want to think about it, you could just place a stop order within your brokerage to go ahead and buy the shares if the stock price were to increase to whatever mark that you set. So that is for the people who are okay with buying the shares. However, if you are not okay with buying the shares, then typically I just set a stop loss to 3x the amount of premium received. Okay, so since we received $548 for putting on this trade, you would just 3x that amount and put that in as your stop loss. And that way your brokerage will automatically take you out of the trade if the premiums were to get to that level. All right, so that is QQQ. However, let's take a look at TQQQ, which is much more suitable for people with smaller accounts. All right, so now we are at the options chain for TQQQ. And now let's go ahead and select our expiration date. Now, while QQQQ has expiration dates every single day, TQQQ has expirations every single week. And so we'll select the expiration date that is closest to the one that we just used for QQQ, which is this one that is 30 days out. So we'll go ahead and select it, and then we'll go ahead and select our put strike. So we can see that the stock price is currently $72 and the expected move is currently $11. So that will put us around $61 for our put strike. And if we look at the $61 strike, we can see that the delta is 0.17. So that fits our criteria perfectly. So I'll go ahead and select that. And then we'll come on over here to the call side at an $11 expected move. That will put us at about $83. So if we want to go just outside of that, we can use the strike of $85, which has a delta of 0.13. So I'll go ahead and select that as well. And we can see at the mid price, we'll get about $205 per contract. And we just need for the stock price to stay in between $61 and $85 by expiration date in order to make the money. And if we like this trade, we can go ahead and hit review, but let's go ahead and take a look at the P&L chart for this one as well. And we can see here, as long as the stock price stays within the range we selected, we just keep that $205 that we collected. But if it goes below our put price, I am absolutely 100% okay with just purchasing the shares at the strike that I selected, because I will then turn around and sell covered calls on the stocks that I was forced to purchase. All right. And then on the flip side, if it were to go up near our $85 strike, then I would just go ahead and purchase the shares so that this position becomes covered. And you can see why it is much easier to do that on a stock like TQQQ than to do it on QQQQ. Right? Because in the previous example, if it dropped below $500, then we would be forced to buy $50,000 worth of QQQ per contract. Well, in this case, we would only be forced to buy $6,100 of TQQQ per contract. And so that is quite the difference. But ladies and gentlemen, that is one of the strategies that I have used in order to reach retirement from trading options in my 30s. I hope that this video has blessed you and that you learned a ton of information. And like I said, if you would like to join the Trader Freedom community, the link is in the description below. We would absolutely love to have you and help you transform your finances. But that is it for this video. Make sure you like the video. Make sure you subscribe, because we have a ton of great videos coming up here soon. And I will see you guys on the next one. Peace.